Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the market's massive week. What we learned from mega cap earnings as a new trading month looms, we will discuss with the investment committee. Joining me for the hour today, Josh Brown, Jenny Harrington, Jim Leventhal, and Kevin Simpson. We will check the markets, and we'll show you exactly what we're doing. S&P, NASDAQ are good. Dow is virtually flat. We do have the final trading day of the month of October. I thought we should discuss what we learned in a week dominated by the mega caps, because it's been the guiding light for this record-setting rally. Josh, I want to go to you first as we sort of take everything in together. Amazon, I think we learned that AWS reaccelerated, the fastest growth rate since 2022. As for Apple, well, the iPhone's back. There's no question about that, even if AI isn't quite there yet and the China issues still remain. Alphabet, maybe the search fears were overblown. They top $100 billion in revenue for the first time ever. Microsoft, Azure revenues up 40%, big number there. And Meta, their CapEx explosion, if you want to call it that. They say 2026 CapEx is going to be, quote, notably larger than this year. What was your big take for the week?
My big take is we were doing shows in January, February, March, and we were talking about, collectively, everyone, if there is a bear case on the market this year, it's the trade war potentially, but it's also if this AI CapEx story falls apart or decelerates or somebody pulls out of the game in some meaningful way. We were saying, like, the most extended stocks in the market, the largest market cap companies, would be very vulnerable to something like that. And I think the message, to answer your question, and by the way, you're wearing the hell out of that sweater vest, and I like it, is we did not get that deceleration in CapEx, and actually we got the opposite. So we're getting acceleration, and we're getting acceleration into 26. So if you were in that camp saying, this is unsustainable, how many GPUs can these people actually need? There's no way these companies are going to continue to spend absent some sort of ROI to attach to the spending. Nope, not what happened. What actually happened was this is the year that it went from being optional and ambitious to spend to existential to not spend. We heard Zuckerberg say things like, I'd rather overspend by $100 billion than underspend. And so, like, that, to me, that's the biggest takeaway of this week. That's what we all come away with. And it's frustrating for the people that are looking for some sort of a turning point or some sort of a rotation out of the tech trade, the AI trade, and into something else. This story just has absolutely dominated the market all year. Yeah. And while we have had other areas of the market perform, which is great, and I'm in those other stocks, this still remains the main event. The good news is, boy, what a way to go out. Even the stocks that didn't react well to earnings, like Meta and Tesla, they're still giving you what you need to hear in order to remain confident. Is it overdone? Should the semiconductor sector have added $1 trillion in 5 trading days? Maybe not. But, like, big picture, the spending's going to be there. They are not relenting. And the financing is in place for even more spending to go into 26.
Right. I think maybe the most interesting development turns me to you, Jenny, in that, Josh is right. It's all about CapEx acceleration. We have made the case, and others have as well, that this market's good and this trade is good until you get a crack in the spend. Right?
Yeah.
But I feel like maybe this week was an inflection point in the way that investors are going to view some of these companies and some of these stocks and the way they, in fact, are spending. And your Meta is squarely in that place where they say that their CapEx in next year is going to be, quote, notably larger than this year. Any other company says, yeah, we're upping our CapEx, it's probably rewarded. There's a little bit, I think, of PTSD around Meta and their money.
Yep.
And how much they spend and how much is too much. And maybe there's going to be more scrutiny on that name going forward because they are going to spend a lot, as we call it, a CapEx explosion. What do you think?
I think that's right. And if you think about every time I've talked about Meta in the last several months, I've said, look, it's still fairly valued compared to its peers. It still has good earnings growth, but to us, we're going to be watching their capital discipline. because you're exactly right. It's the PTSD. And when did Meta explode from whatever it was, like $70 a share to the 700 and change? When that started was when Mark Zuckerberg got fiscal discipline several years ago.
Yeah, let's go to a 3-year chart of Meta as Jenny continues the story, because it tells a good story. Just the chart alone. If you look at, or even a little bit further than that, you can look at a 4 or 5 year, whatever. But go ahead. I'm sorry.
No, it's fine. So, so I think that's the challenge with all of these is going to be, where's that line between what you showed that clip of Mark before, where he said, I'd rather overspend by $100 billion. Well, you know what? He can afford to overspend by $100 billion right now. He couldn't afford to overspend by $100 billion several years ago. A lot of these companies can, but it's going to ultimately be a fine line between who overspends severely, who spends correctly. I don't know what's going to end up being right, a little bit of underspend or a little bit of overspend. We're in a very euphoric, extreme kind of sense right now.
Do you think the market is questioning the degree of spend because it's not sure, specifically related to this company, what the ultimate payoff is going to be? Because the market doesn't seem to have that question about the others.
No,
so
I don't
why
think so.
would it be worried about that with Meta?
Well, I think it had to do with like that tax and their earnings, and maybe that was a little disappointing. Like, it might have been more granular. It might have been that Meta's performed better than almost all of the peers year to date. So taking a little bit off the top wasn't the worst thing.
Not more recently, though, right? Not more recently.
No, but if you look at it year to date, on a year to date basis, you still have Meta up 14% versus like Apple up 8%, Tesla up 9%, Amazon up 1%. So like, and that's before this. But like on a year-to-date basis, it was still one of the stronger ones out there. I don't know. To me, it doesn't make great sense. I think it's something that's probably not worth overanalyzing. I think we pause for a couple days. And the other thing is too, when you think about Meta versus an Apple, for example, Meta's got a better AI strategy, and they're going to start to monetize that. They reported 28% growth in advertising, just to give you like a little bit of versus Google, where they reported 14% growth in search. Like, I'd rather have Meta's 28% growth in advertising versus Google's 14% growth in search. I'd rather reward that stock. I don't really know why it wasn't rewarded.
I mean,
maybe it's a cynicism.
Kevin,
it doesn't make sense to me.
Kevin has Microsoft and Meta and Amazon and Apple, so you're a good person to hear from after the week that was. And how you're going to judge, and how the market itself is going to judge what these companies are doing, what they're spending, and what they're ultimately going to get out of it.
Last Friday, I said Amazon was my final pick of my final trade, my pick of the week. I wanted to get into it before earnings. They blew it out of the water. We were looking for AWS, we were looking for advertising, and they couldn't have been stronger. I thought the Meta numbers, to Jenny's point, were very solid. I'm surprised that the stock has sold off to the extent that it has. But as you were having that conversation and talking specifically about Meta and this underperformance today, what popped into my head is AWS, Azure, Google Cloud. Those are revenue streams that those other Mag 7 names have that Meta doesn't. By choice, it's a closed ecosystem, which I think is to its benefit. So if anything, I would look at this opportunity as a means of adding to Meta or buying it if you don't have it, assuming you believe in the long-term thesis, which I do.
JP Morgan has an interesting note today. They talk about the love affair. It's the words that they use with tech in the Mag 7. They think it remains extreme. The dominance of AI stocks continues to drive the largest consensus earnings upgrades. However, there is also emerging signs of a peak in sales and earnings revisions on the horizon. Coupled with elevated price-to-sales ratios for Mag 7 stocks suggest a growing risk of a swing in risk-reward and potential for mean reversion heading into the coming year. Thought that's an interesting note. Tony Pasquarello of Goldman Sachs publishes on Fridays, generally speaking. I do have his latest note, which just moved a few moments ago. Whether shareholders like it or not, he says, it was clear, absolutely clear from Q3 earnings that the hyperscalers are still on the gas. Again, I'm not smart enough to know where it all ends up, but I agree with this argument. There's no reason to sell your names with leverage to the AI supply chain today.
I think we're on the backstretch. Whether you're looking at this as a race of the large language models or the CapEx expenditures, this is a horse race and you're on the backstretch. stretch. Now, on the back stretch, you're going to see one horse pull ahead and another one pull back, and then it's going to change. Bryn Talkington sent me a couple of days ago a chart of AI traffic, and it shows OpenAI is clearly the leader, and the others, whether it's Claude, whether it's Gemini, or some are leading one month and then giving up ground the next month. But we're on the back stretch. We haven't even hit turn 3 yet. So, Meta may be having a bad week. Perhaps it's because Llama isn't getting as much press as maybe Gemini is this week. But again, that's just for now. These things will change. I don't think this, even though I'm not in Meta, I don't think this is a time to sell Meta stock. I don't think this is a time to sell Google stock. I think there's a lot of legs ahead to this race. And this applies as well, not just to the large language models, but to the actual CapEx. Whether we're talking about NVIDIA versus Broadcom versus AMD, these are all likely to succeed for the coming months. Will there be a time where this trade corrects a little bit? Sure, of course there will. January seems like an obvious candidate as people are holding off selling to cross into the next tax year. But again, just a correction. This race is far from over.
The spend is incredible. It really is. Amazon is going to spend $125 billion for 2025. That's a raise from what was 118. Meta is going to be a range of 70 to 72 billion. That's up from their prior range. Alphabet, 91 to 93 billion, above their prior range. Microsoft spent 35 billion in Q1. It's going to spend more in fiscal year 2026 than in 2025. I don't think anybody's surprised by that. The question, Josh, I suppose, is whether there's this brewing bubble in CapEx and whatever else, to the point where Michael Burry, who obviously of fame from the housing crisis in 08, puts a social media post out that says the following, and I think we produced this up so you all can see it. Sometimes we see bubbles. Sometimes there is something to do about it. Sometimes the only winning move is not to play. Cryptic as usual, thought-provoking as always. What do you think?
Well, I think Michael Burry's right. Sometimes when there's a bubble, and it's so hard to understand whether or not it's a bubble based on future fundamentals that are about to deliver, which I think is what we would say. Like if we went back in a time machine a year ago, a lot of the same people were saying this AI stuff is a bubble. Well, here we are a year later. Most of these stocks are up double digits. Some of them have doubled and tripled that are in this ecosystem. So it's like, all right, maybe you'll eventually be right that it was a bubble. But, I mean, come on. Look what's going on right now. But so I do agree, like, if you're not a professional short seller, you probably should not be spending a lot of mental energy trying to figure out, like, all right, now is when I want to make an aggressive bet against this trend, because it could run you over, go on for years. But I want to go back to Meta. Why is that the odd man out this week? And I think it's obvious, and we didn't get into it, and we don't have to spend a ton of time on this, but the street is not convinced that Zuckerberg's strategy has a payoff. And they've now had, by one journalist's count, 5 restructurings of their AI initiative in the last year. That's like unheard of. They're moving people around from one team to another. One day they're doing layoffs. The next day they're acqui-hiring companies for billions of dollars just to get a few engineers. Like, people are looking at that and saying, all right, this seems less focused than, for example, what Alphabet has been able to achieve, which, by the way, Jim gets a ton of credit for having said, hey, it's too early for us to decide that Alphabet is lost. He was dead right. I was wrong. And the best metaphor for this maybe is not a horse race. Horse races are over in 30 seconds. It's a baseball season. And think about during the course of a baseball season, these teams, they get hot, then they go into a slump, then they get hot again. So I don't want to make too much about Meta stumbling this week and overreact to the price action after one quarter. But if you ask people that cover Silicon Valley, like the media who speaks to executives in Silicon Valley, clearly Meta is the company where there's the least certainty about what they're actually even trying to do. They've got an open source model, Llama, which is fine. Are they getting the same traction that OpenAI is? No way, not even close. So that's why it's the ghost of 2022. Everyone remembers how it was totally cool for Zuckerberg to spend and spend and spend on virtual reality projects. And then one day it wasn't. And it wasn't a 10% sell-off. It was a 70% peak to trough decline in the stock. And so that's what I think people are skittish about. The other name that there was a lot of doubt about was Amazon. And I'm long the name, and I've been wrong on this one too. It's finally working. I thought earlier this year, if there's going to be this CapEx boom, surely AWS is going to make the most hay. Did not work out that way. I thought last night was a statement quarter. I think they reminded everybody, hey, we're still the biggest. And this is the quote that I think the desk would probably find the most interesting. They said, it's worth remembering that year-over-year percentage growth is a relative term. It's very different having 20% year-over-year growth on a $132 billion annualized run rate and to have a higher percentage growth on a meaningfully smaller annual revenue, which is the case of our competitors. Little shade, little subtweet there, but AWS is still the biggest, and they can't grow it. By definition, you can't grow that materially faster than companies like an Oracle that are coming off of a slower base. So I do think it's a really long baseball season, and maybe this is just a slump for Meta, and they'll get back in the game, just as we saw with Alphabet earlier this fall.
I want to go back to the Burry post and discuss, if you look at CapEx, obviously it raises a lot of questions. If you look at data center, it obviously raises a lot of questions. I think even the people who say, no, it's not a bubble now, admit that it will one day be. You're inevitably going to overbuild. Maybe are you also going to take on too much debt to do it, right? Debt, as we've talked about so many different times, is the undoing of a cycle, right? It's the thing that once it gets too far down the road, as you're borrowing a heck of a lot of money. I almost said something that would have got me in trouble. A heck of a lot of money to build these data centers. The spending, borrowing to fund AI data center spending exploded in September and October, according to Bank of America. We have a chart where you can see the incredible rise of borrowing to build, which obviously raises questions. Wall Street Journal related to build more than a $7 billion data center for Oracle and OpenAI's Stargate. We get these announcements every day. Something to be concerned about?
This on? Because this, to me, and I said this yesterday, I'm going to repeat it, it's corporate finance 101. The cost of capital is cheaper for debt than it is for equity. If you're going to, say, issue Oracle shares for the funding of a data center, you're probably giving up a return on those shares much greater than if you use debt financing. But the thing about debt financing is you have to have something to collateralize it, and in this case, if you want to get meaningfully low interest rates, and in this case, you have that. You have that in these data centers, and I'm not suggesting that the data centers will be put back to the lenders. What I am saying is, yes, that's a fallback. There are cash flows from these data centers that underwriters of bonds can point to and say, yes, I feel safe enough with these cash flows that I'll charge Oracle 5.5% to finance this debt, as opposed to what Oracle would have to do is give up probably 20% if it were using shares in the company to finance it.
The other story I want to get to is a move from Kevin, just because it's so far away from this new tech story to theoretically old tech, but a company all that's old is new again, and that's IBM, which continues to prove itself that it has in many ways reinvented itself. It is no longer a financial engineering story as critics would have charged it to be over the last however many years under the transformation and the current CEO has led this company on. IBM's pacing for its 10th positive week in 11. It's a record high as of earlier this week. There's the chart. It's pretty compelling, which is why you look at that and you bought more.
To your point, we also went through a 4-year period where we basically made no money with IBM as it was churning.
And many gave up on it, by the way, fed up by the period of the inability for revenue growth and what seemed to be left for dead in a new tech universe.
Given a few more months, we probably would have joined that list. I mean, it was getting to the point where you saw all of these other tech names having incredible performance and IBM continuing to languish. Maybe the Red Hat acquisition didn't work in the early days, but it's certainly become something, even if by accident, that's incredibly AI adjacent, very profitable. The quantum computing is, without question, something that we're very excited about. Even the conversation where they can use some of the lesser expensive chips, I think it was AMD they were talking about, to be able to run some of their quantum programming. So you've got an old school company with a new school mentality, nice dividend, incredible management, and one of the best turnaround stories we've seen in recent times.
You seem like you're still looking for opportunities to put more cash to work. You bought more Syncora, you bought more Allstate, you bought more Depot, and you bought more Walmart. You don't need to go through and tell me why on each, but the blanket sort of idea of what I said.
So the blanket idea is that none of those names have anything to do with AI.
Yeah.
And our thinking is that if this trade is bubblicious, or whatever the word was, that maybe we need to expand our mindset outside of that and continue to build up some of these names that are out of favor. I think the forward PE on Allstate, I'll just point that one out, is like 7.5. So it's different than everything we're talking about from a valuation standpoint, that maybe we're seeing things stretched to the limit. Yeah, insurance companies have been very poor performers as of late, and this may be something where it takes us a few years to pay off, and maybe there isn't the rotation out of tech and the broadening of the market tomorrow or the next month or two, but I do think it will happen.
How about Netflix? We need to hit that. Stock's up better than 3%. Josh, so you got the 10 for 1 on that. The stock's been interesting coming off the earnings. There are now, reports of possible interest in some piece or whatever of WBD. We shall see. But what do you think? It's down 9% this month. Market likes this move.
Yeah, so I've been in the name for a long time. It was added to my list of best stocks in the market, and then it fell off that list on the heels of reporting the last quarter, which was really not well received at all. I said at the time here on the show, I thought it was a ridiculous overreaction to something that was so arcane and irrelevant to the business. A minor tax dispute with Brazil, which was not in their guidance, cost them what looked to have been an otherwise pretty good quarter. Guidance was good too. So I still don't quite understand why it hasn't recovered yet. It's starting to claw its way back above the 200-day moving average, but I don't trust it yet. If I were entering for a trade, I'd want to see another day or two of follow-through after today. So I'd maybe take a look Monday or Tuesday. As far as the reports on, I think Reuters broke the news that they engaged Moelis to prepare a bid for Warner. So the thing is, I don't know if they just do that all the time whenever there's an asset for sale, because they don't actually end up consummating any of these deals. Netflix is always in the conversation as a potential buyer. It's a $500 billion market cap. They have a gazillion dollars in cash flow they could use, but like they never seem to actually do it.
Because, I mean, the story has moved a bit, right? There was the marketplace took from a comment that I think it was their co-CEO had made, whereas, we're builders, we're not buyers. But then David Faber obviously had reported, okay, well, if you want to talk about a group of companies that are definitely interested in some form or fashion, in some piece, if whatever, that they're on the list. And now you see this other reporting that they've hired, a banker to at least take a look at the idea. So maybe there's just certain things that are too good to pass up, even if it flies in the face of what holistically they believe in and who they think they are.
I mean, this is like this. Okay, it's an incredible library, an incredible content producing studio. Like it's one of the crown jewels of Hollywood and globally. The titles that we're talking about here, you cannot emphasize enough how incredible it would be for any streamer, especially Netflix, to take things like the DC universe and Harry Potter and a library that includes things like Casablanca, and not only put those things on the streaming service, but create brand extensions, new shows based on them, sequels, reboots, spin-offs, 100%. But the price, if you take the equity market cap and then you add back in the debt, the enterprise value, and you try to figure out, like, all right, maybe it's a 20% maybe it's a 20% premium to wherever it's trading right now. Like, you're talking about a $70-80 billion deal. Is that Netflix goes from doing no deals ever to buying something for $80 billion and assuming $35 billion in debt? It just sounds fantastical to me. I think it's possible that they just are doing their due diligence and it's an intelligent decision to make a bid. What does it really cost them? I don't know how badly they want it. So, look, I won't be the first person to know if this is really going to happen. I do find it interesting, though, that the street seems to be reacting positively, and maybe they want Netflix to be more aggressive. I'm just looking at the share price today.
Well, the split probably has something to do with it, too, right? We know how, generally speaking, the market has rewarded companies that do that sort of thing. All right, good stuff. So we're going to take a quick break. All right, welcome back. Time for Josh Brown's best stocks in the market. The spotlight today shining on who?
Believe it or not, Ford and GM are on my list of best stocks in the market. And this would have been very difficult to have predicted this spring when we were all worried about tariffs, because, of course, these companies were right in the automobile in general. That business was right in the crosshairs. But very quietly, these two companies have put together an unbelievable year. GM is up 32% in total return. Ford is up 41%. Best year for Ford since 2021. They're actually outperforming Tesla. So it's really an extraordinary thing. You know, a lot of people wake up in the morning and they ask themselves, what do I know that the market does not? Like, that's the way that they think they're going to invest. Sean and I, when we're working on this list, we think about things in the opposite way. We say, what does the market know that we don't? And in the case of Ford and GM, it turns out auto sales are much more heavily influenced by the stock market wealth effect than they are by the impact of tariff-driven inflation. And that's really the story on these two names. People are feeling really good about their situation, and they're going out and they're buying more Ford F-150s. They're going out and they're buying Yukons and Denalis, and that's reflected in the results that these companies have had. I think from a technical standpoint, I don't trust Ford. Ford has gotten to this $14 level a couple of times and been turned away. I really wouldn't pull the trigger here on a long until it can clear that, and I want to see it do so with a healthy RSI in the 50s or 60s and high volume. If it can do that, I think it sets up for a really interesting trade, but not until. On GM, they're way ahead of Ford in many ways. Better expense, better control on expenses, more profitable. Instead of this silly dividend, they're doing a much better job returning capital via buybacks, which investors seem to prefer these days. And I think what you want to do here with GM, you want to watch for a low volume pullback after this parabolic post-earnings move. Let's say you see it in the mid-60s. That's where you want to get long the name. I think it's pretty clear that should present trends continue, they should have another good quarter in Q1. And look, this is a huge move for a non-tech stock, and it should be emphasized. These companies don't break out like this very often. But I just love this idea that no one in a million years would have guessed that this would be the year these two names would perform the way that they did in light of all of this stuff going on in the backdrop. And I think it goes to show why we want to focus on price first and then try to understand the fundamental story of why people are buying.
All right. We'll get away from tech earnings next week and talk about TripAdvisor and Marriott and McDonald's and DoorDash and others. Jenny, Trip.
Yes.
Thursday next week.
Right. So it's a really important earnings report because what we want to see is that the legacy TripAdvisor is actually stable and that Viator is still growing. Just on fundamentals, this thing's ridiculously compelling. It trades at 8.5 times earnings, has an 11.5% free cash flow yield, but it's really about those legacy businesses and what they're doing right now. So should be a good quarter.
You like Marriott?
Should be.
Tuesday before the bell?
Yeah, we love Marriott. So here's one that trades at 23 times earnings and has this super long history of just growing consistently. Earnings growth ahead is 13 times, 12 times, 10 times. I think what I'm looking for in this is a read on the consumer. Josh made a point earlier on the autos where you said, Josh, you know, your investment thesis is on if the trend continues of the consumer staying strong. We're seeing I think we're seeing a lot of cracks and a lot of bifurcation in the consumer. And Marriott's a great company to listen to get a feel for what the consumer is really looking like.
Kev, of McDonald's, DoorDash, and DraftKings, which are all next week as well, which one are you most excited about?
I could easily say DoorDash because I'm tepid on the other two. I think, we like convenience. The expectations for numbers on DoorDash, 40 to 45 cents a share. That's going to be versus a loss of the same period last year. So if anything, you want to look at DoorDash before the print.
Jimmy, you got Wynn next week and Vertex and Apollo.
And Qualcomm. I'm sorry you didn't mention that.
Yes, and Qualcomm. Thank you.
Qualcomm is kind of the most important of those because they had that announcement earlier this week about the data center chips, and it's going to be very curious to see what the analyst questions are about that. The numbers are going to be what the numbers are. They're not going to have any of these AI chips in it, but what is the tone and verbiage from the analysts? That's going to determine what the recommendations on the name are that come out afterwards.
Okay, give me something else. I don't want
Wynn.
that.
Wynn. Look, Wynn trimmed it at 126, is now around 120. I think it's a little expensive. Let's see if we get a price break there because I'd like to reload after that.
You got Pfizer as well, Jenny. You got Stanley Black & Decker, and you got Devon.
Yeah. So I've had an interesting week this week. I've actually had half the portfolio report in the last week, and everyone's coming in line. But what's interesting about and by the way, I'm talking about the equity income strategy right now, so the dividend stocks. So what's been interesting is the response has been remarkably good. Like an inline, not as bad as expected. I think my stocks are beaten up this year, and so just these inline reports, I'm seeing 3%, 8%, 9%, 11% responses. I expect the same from all of those next week, that they'll probably report just in line, and it'll probably be well received because it's a relief that things aren't really that bad. And by the way, those stocks are all cheap, like 15 times, 8 times earnings.
There's one stock in particular that you have that's getting beaten up today.
I've been waiting for it, beaten up this week.
I'll let you relax over the break, and we'll do it next.
Okay.
All right, welcome back. We'll show Fiserv. It's having its worst week ever. They cut their full year guide. The stock is obviously not doing well. It's up there today, right now, but it is in the midst of the worst week ever. Down 48% on that week. Or what do you do? Something like this.
This is so hard too. So I just want to say one thing. This happened on Wednesday. So Tuesday night, we have Teradyne in the same portfolio. This is in our growth portfolio. And I'm like, oh great, we're gonna have a great day tomorrow. Teradyne's up 20%. And then you just get slapped. So you can't even enjoy the victory. I always think it's like being a portfolio manager is like being a parent. You're only as happy as your least happy kid. So this is pretty unhappy. But what you do. So we own this going back 10 years, and our cost basis for the original accounts that owned it is $25 a share. We still have a really big gain. And I always say this, your starting point is today. And the starting point today is there's a new CEO, he has kitchen sinked it all. It's still a great business. It's Clover, it's Zelle, it's the backbone to major banks, technology and transaction processing. The new CEO is terrific. He's from PNC. He's brought over the president of the processing payments at JP Morgan. So it's a really good management team. So with the kitchen sinked quarter, you now have a stock that's going to earn $8 a share. I think this is a trustworthy estimate because the guy has just taken everything out and put it all on the table. So you've got a stock that's trading at 8 times earnings. It should go back to decent earnings growth ahead. I don't think it's going to be double digit. But what you do now is if you have a tax loss, you take that tax loss. If you have a big gain, I think you keep holding it. Even if we take the tax loss, there's a really good chance we put it back in the portfolio 31 days later.
All right, so you have a big gain, so you're holding it.
Well, it's mixed, right? Clients that came into us 10, 11, 12 years ago, they have a big gain. Newer clients have a big loss. So it depends on what your cost basis is.
Okay.
It's tough.
Okay. So it's not a one-size-fits-all strategy on something like this.
No, because I think long-term the stock's okay.
Okay, gotcha. Good stuff. Thank you for that. Finals are next. Let's do final trades. Josh, you're up first.
Rocket Mortgage, great quarter, very tough environment that should be getting better.
Kevin?
Meta.
Jimmy?
Cleveland Cliffs.
And Jenny?
Bristol Myers.
All right, well, at least 3 of the 4 are in the green today. We also, Tom Lee's joining me. Eric Woodring will be around for Closing Bell as well, and I'll see you then in a couple hours. Brian, thanks so much. Welcome to Closing Bell. Scott Wapner live from Post 9 here at the New York Stock Exchange. This make-or-break hour begins with 2 months to go. Whether this rally is ready for yet another burst higher, we'll ask our experts over this final stretch, including FundStrat's Tom Lee. He'll join us in just a little bit. Look forward to that. In the meantime, let's show you the scorecard here with 60 to go in regulation today. October all but in the books. Stocks on their way to a 6th straight month of gains. Amazon and Apple both hitting record highs today following their earnings report. Nicely received. Look at Amazon. That's the big winner. Utilities, materials, staples are among the weakest areas today. What about Fiserv? About to close out its worst week ever after cutting guidance. Yes, the stock is in the green today, but it's been a terrible week, as a chart will show you. We'll show you that as well. Netflix popping after announcing its 10-for-1 stock split. That's a big story. We'll follow that. It takes us to our talk of the tape. The rally's road ahead as we ready for a new month of trading. Let's bring in now our panel. Hightower Stephanie Link, a CNBC contributor. So is Big Technology's Alex Kantrowitz. They're both here at Post 9. It's great to have you both with us. Steph, your biggest takeaway from what you got this week as a shareholder in Amazon, as a shareholder in Meta, and now for the first time ever, a shareholder in Microsoft. Welcome.
Thank you. Well, expenses are going up, but we are also seeing substantial growth across every one of these companies. And earnings estimates after all of these reports are going higher. It's 25% of the S&P 500, these 5 companies that have reported this week. With numbers going higher, I think that's very positive for the overall index, the S&P 500. I feel really good about Amazon. I don't feel as good about Meta, but I bought some yesterday. Microsoft, as you mentioned, I added. I'm looking for opportunities because I still see the growth, and I still think the CapEx numbers that we're seeing are going to fuel the longevity of AI, right? I mean, you're going to do something like $400 billion from the big 6 companies in CapEx this year. You're going to do something like almost $600 billion next year, $700 billion the year thereafter. So you have a tailwind. I know these stocks are up a lot, Scott, but I'm looking for any opportunity to be buying.
Okay, AK. I mean, it feels to me like the reacceleration of AWS to the highest growth rate in years is the biggest takeaway of the whole week. Is that right?
I would say so, and a couple of things. First of all, don't discount Anthropic in this story. Anthropic has been a big AI partner for Amazon. There are reports that it's going to account for 2% of AWS's growth this year. They're, of course, taking billions in from other companies, from other investors, from sovereign wealth funds, and then plowing that into AWS. So that is part of the growth story here. And I think more broadly, when you think about the growth in all of cloud, you're seeing that right now after a long period of maybe these companies will make money by investing in generative AI technology, the end users, or maybe they won't. There was an MIT study recently that said 95% of people, or 95% of companies are not getting a return. Now that story is shifting. A Wharton study came out this week that said 74% of enterprises that invest in generative AI are seeing a return. If the end user can start to see a return, then this doubling of capacity that Andy Jassy is talking about is really going to pay off, and we will see sustained numbers for these data companies.
I love what we just showed you on the screen, guys. Put that back up if you wouldn't mind, please. The AWS growth by quarter is a really clear picture of the acceleration, the reacceleration that you have seen. There it is, right? It was somewhat flat, then declined, and now you have a burst higher. Do we come out of this week feeling as good as we did going in about the whole AI trade? Do we have new questions about dollars being spent versus rewards on the other side?
Okay, so dollars being spent is substantial, and that's why Meta was down so much, but they are seeing an ROI,
Everybody's
Scott.
spending, though, right? I mean, why Meta? Because, look, Amazon is up to $125 billion for this year.
Right.
That's the most in the group. Meta 70 to 72, Alphabet 91 to 93.
Right.
Now, all of those numbers have steadily risen, but why so much the focus on Meta and the questions there when Amazon's spending a lot more?
I don't think that they get they're not being appreciated for the ROI that they've already seen from the spend that they've already done. So advertising was up 26%, impressions were up 14%, price per ad was up 10%, time spent up 5% at Facebook and Threads, and up 30% in video. You want to sell that because they're going to actually increase their spending? Obviously, they're spending to grow, and they're spending for talent. I was not happy with it. Let me tell you, the first thought out of my mind was they're raising expenses again, but it's working. So that's that one.
Is it? Are you sure it's working?
Yeah. When you grow revenues 28 or 26%, 4 percentage points better than expected. Operating margins beat as well. And I just mentioned all of the monetization part of the story. So they are monetizing. Give it a rest for a couple of days, then you add, but I added yesterday on Amazon, AWS at 20%, they were capacity constrained. They're going to double their capacity over the next 2 years. So that means you could probably see 20 to mid-20s in AWS for the next several quarters. That's the nuance to this story. And backlog was $200 billion, up 22%. They got more business wins in October than all of the third quarter. And oh, by the way, throw in retail and retail margins. That's also a positive as well.
What about this Meta question?
I don't give them a pass. Sorry, Stephanie, but I think I'm not giving them a pass.
Let's debate it. Go ahead.
Here's the thing. Well, there's the obvious part where Amazon spending, it's going to be correlated into cloud spend. Microsoft spending correlated in cloud spend. Yes, Meta will get maybe a bump on advertising, but I don't think that's a revolutionary bump. Maybe it's an evolutionary bump. And the key thing with Meta here is, as this spending increases, it shows that there's actual fear within Menlo Park, that it's not just that this technology will be a new way to search information, it will be a new social interaction on the internet. And I know that sounds weird to say, but more and more people are forming relationships with these chatbots. And not just romantic, but friend relationships. This is what Meta is trying to build as well. Mark Zuckerberg's spending all this money indicates that he thinks that this is a real threat. And if this is where engagement goes on the internet, that's going to be a problem for Meta.
You mean it cannibalizes
sorry,
Facebook and the interaction that people have traditionally had on that platform?
Yes, I believe so. And look, the proof is where people are moving. A large part of OpenAI's higher ranks are people from Meta.
We want imaginary friends rather than real ones?
Yes, yeah, I think OpenAI really believes this, and they have people from Meta. They've written memos talking about how they want ChatGPT to be a toothbrush product, basically meaning that you use it as often as you brush your teeth twice a day for 1 billion people or more. And so they are playing the same game. It's an engagement game. It's a time spent game. And Mark Zuckerberg is looking at this. He's seeing his former executives over there, and he's saying, I can't lose that battle. I want them to be doing this on Meta products. Maybe it's a friend. Maybe it's an informational buddy. My prediction is it becomes something of both.
60% of the world uses some sort of Meta product. That's number one, a huge moat. Number two, I mentioned it before, but time spent is a big deal. You just mentioned it. They're getting it. They're seeing an increase. Video is where it's going, and they're seeing a 30% growth because of AI. That is a huge return on their investment, and that is going to lead to continued growth. Family of apps came in at 26%. And it beat by 400 basis points where consensus was. That is a huge, huge number and momentum. I care about the growth. I obviously care about the profitability too. That's very, very important. You hear me talk about margins all the time. So obviously disappointing. But you're not going to see a massive decline in margins. You're just going to see a level off next year in margins.
But Alex is talking about like existential threat to what this company in many respects has always been.
And can I say one more thing about this? The top app on the App Store for much of the past 2 or 3 weeks has been Sora, an AI-generated video TikTok competitor. Now, is it going to stay there forever? I don't think so. But you have to. There is a new paradigm that's opening up in the world of entertainment and in the world of communication online. And if Mark Zuckerberg didn't think that this was a big threat, he would probably just use some model off the shelf and build some fun products with the Meta. But that's not why he's going all in. And I think it's smart that he's going all in. But that doesn't discount the threat the company is facing.
Let me change it to Microsoft before we move topics altogether, because we spent 9 minutes. No one even mentioned that name. Well, I mentioned that you bought it for the first time.
Yeah.
But do we take for granted what they have? The revenues that they're going to get from OpenAI, the solidifying of the relationship over this week as OpenAI sort of solidifies its own structure moving into the future?
Yeah, I think they're very well positioned, number one. The quarter itself, they beat in all 3 segments. Commercial bookings were up 111% year over year. RPOs were up 51%. That's a future indicator of revenues to come. And then you had Azure at 39%. And the stock fell because people thought that they would do 40%. But it's still up from 37% last quarter. So to me, their momentum is still absolutely there. They've got the partnerships. Oh, and by the way, operating margins They were up 230 basis points year over year, and they beat expectations by 230 basis points. All of it was really, really good. Very hard to find anything that was really bad.
All right. Hang with me. We're going to make a pivot, and we're going to come back. Because Apple's hitting a record high today following its own earnings report. Our next guest also raised his price target on that stock. Morgan Stanley's Eric Woodring. He joins us now at Post 9. It's good to have you here as well.
Thank you for having me, Scott.
What's the takeaway from this? The iPhone is back, albeit we still have questions about AI?
Well, this is an exciting conversation about spending because actually Apple has been the one left out of this conversation. They just told us that December quarter operating expenses were going to go twice as fast as normally seasonal. I have OPEX growing 18% year over year for Apple in fiscal 26. They're not afraid to spend, but the point is they might not be spending in the same way that the rest of these mega caps are. Their business model is different, but now they're getting into the AI spending game. That is spending on infrastructure, that's spending on headcount. And we know that Apple is usually pretty disciplined about where they put their incremental dollars. It just adds some dynamicy to the story because alongside that, iPhone revenue is accelerating, double-digit growth in the December quarter.
Right.
In the second half of the year, iPhone is growing the fastest it has since 2021. So you can at least take some solace in the fact that growth is accelerating while expenses are also accelerating.
Okay, these other companies, and I read off all those numbers, you know,
Yeah.
the CapEx, because they're builders.
Yes.
Right? They are building out whatever their AI systems are going to be for the future. Apple has always thought of itself as a builder too,
Yeah.
right? Builders, not buyers.
Yep.
Now, because their spending now lags because their business model is different than all of these others, do you think they may actually be a big buyer of something and that changes the dynamic? The money is spent.
Right.
It's a large number. It's just spent on something else.
Well, I would call it a hybrid model in that they're definitely building something internally, but at the same time, you know, Apple has made a lot of money being the distribution partner for Google Search, right? 15% of Apple's operating income comes from just being the platform to distributing search on Safari. That's a pretty lucrative business for them. Getting in the business of distributing others' large language models where they invest that CapEx into it, that's a pretty high ROI business. So my point really is Apple does believe that they can build some of their own internal technology, but a partnership model and a hybrid model is really where they're going. And if I just get back to that OPEX comment,
Sure.
they're talking about infrastructure. If you're spending on infrastructure and OPEX, that means you're not generating revenue from it because otherwise it would be a cost of goods sold. So this is training large language models on someone else's cloud. That gets you excited to think about what could come in the future, but the spending is clearly there. It just shows up in a different way than these other mega caps.
What do you make of the run that the stock has had?
Yeah.
Is it all based on just such a low bar for where the iPhone was to where this cycle appears to be? You raise your price target to 305. That in and of itself says that you're a believer in the trajectory of this story.
Right. So I think there's two things. One, yes, you know, the bar was frankly low. Apple has not grown at the same pace that it historically has over the course of the last, let's call it 6 quarters. But at the same time, the iPhone 17 is doing better. People are buying the iPhone. The iPhone is 53% of total revenue, and not to mention services is outperforming. I don't want to skirt over that. Services is growing 14% annually. And so, you know, why has Apple gone up? Because estimates have moved higher. And the important thing, at least about where Apple is right now, is there's a lot of ways that you can win next year. In some cases, you have to dream the dream to be totally fair and balanced. But at the end of the day, you can look to the iPhone 18 and say they're coming out with their first foldable. It's going to be expensive, but Apple iPhone owners are usually willing to pay for that.
Right.
You can amortize it over 3 years. There'll be carrier discounts and whatnot. But your first real major innovation in a number of years with your core product, and you can say the iPhone 17 is doing better than expected. That just gives you some confidence to say, well, if I normally price in the next cycle 6 months in advance, if I can gain comfort with the current cycle, maybe I can own Apple a little bit earlier for that next cycle.
I feel like after the last earnings report, we were maybe too quick to say, okay, China looks like it's turning a corner.
Yeah.
and now we leave asking similar questions again as to where that part of the business is. You have an idea?
Yeah, I wouldn't say that it's turning a quarter yet. China is still a very difficult market. There are subsidies still in place in the Chinese market that help your lower end phones with demand. Again, not your higher end ones, but China declined in the quarter, right? China declined 4% year over year in the September quarter. They're telling us it gets back to growth in the December quarter. I would characterize that as a reflection of early demand for the iPhone 17 in China is strong. Let's not go beyond that quite yet.
I always like talking to you about this because even though you're positive on the story, you're not blind to the issues or naive to even what you yourself know are issues that exist. Like Stephanie Link, to my left, if I bring them into the conversation, is probably going to say stock's expensive, right? In her mind, too much so, for a declining growth rate, right? She's just not willing to pay up for that anymore. How would you answer that?
Yeah, so listen, that's very fair when you're looking at a broad universe of large mega cap tech stocks, right? My universe is tech hardware, and Apple is the standout most often. But if I'm talking to a global tech PM, what I would say is, if we look back to the 2021 cycle, Apple peaked at 35 times earnings. That's when services was 31% of gross profit dollars. Today, it's 43% of gross profit dollars, and there's a very clear linear correlation between services mix of gross profit and the multiple. So there is at least valuation to support to say, if the iPhone is accelerating, if we can get 2 years of back-to-back strong growth, then we can make the valuation argument on top of it to say, no, it's not cheap, but if estimates are moving higher, the multiple will move higher.
Interesting. That's a really well put rebuttal to that criticism.
It is, and 35 times for a peak. I get it. It's at 33 times, so it's not really compelling in my mind. The historical 5-year historical average is 28 times. I know, I get the whole cycle thing. I'm not in the camp of iPhone 17 being super cycle. I know it was a very positive data point yesterday when we got the numbers, so I get that. I just don't think you're going to get an acceleration from like double digits in December quarter. I think you could roll right back down to single digits, and that's that little cliff is something that worries me. Services, I get it. I mean, I wish it was bigger. I think we all wish it was bigger, right? Because that's the most exciting part.
It's like a Fortune 50, I think, in and of itself. So
and they do an amazing job with gross margin. So there was a lot to like. There's a right price, and I don't think this is it.
No, and I think Stephanie, your point is correct in that the December quarter also reflects the fact that September was capacity constrained. So if you look at the 2 quarters together, iPhone's growing, call it 9%. So better than it has been. You still want to see it get better. And ultimately, you have to make sure you're tracking the data to ensure that happens. And so I think your point is very fair, Stephanie. Again, the only rebuttal is, if we do believe that the iPhone 18 can be the phone with a foldable and higher ASPs that can drive that acceleration, I think in some cases you'd be willing to hold it for that kind of glory period, that kind of cycle when it comes to the iPhone 18. But by all means, Apple has to put up the positive estimate revisions to get to multiple expansion.
So we can talk in the summer of next year.
Last word.
I think it's pretty incredible what Apple has done. There were a couple of years pretty much where the iPhone was either shrinking or growing single digits. Now it grew double digits last quarter, and as Eric said, maybe 9% this quarter, 9% next quarter, or even more when you see the numbers. This is a real reversal for Apple, and it's going to ride this strength, especially as it goes into that 18 if it is foldable. I've said it before, I'll say it again, people who hold foldable phones seem to be happy. And I think it's going to be contagious, and people will buy a lot of that model.
Smart conversation. Made so by you guys. Thank you very much. It's great to have everybody right here at Post 9. Let's send to Christina Partsenevelos for a look at the biggest names moving into the close. Christina.
Thanks, Scott. Well, let's talk about Netflix shares on the rise after the streaming giant announced a 10-for-1 stock split just yesterday afternoon. Reuters also reporting that Netflix has hired bankers to evaluate a bid for Warner Brothers as well, Discovery Studio and streaming business. So a lot going on there. CNBC's David Faber reporting earlier today that Netflix's interest is very serious, and that's why shares are up 3%. Meantime, Coinbase shares, look at those, up about 6%, beating revenue, climbed higher than expected, driven by strong transactional revenue on both the consumer front and the institutional investor front. The crypto exchange also increased its potential share buyback from $1 billion to $2 billion, shares up 6%. Last but not least, First Solar shares are let's see, higher. They're almost 15% higher, not because of earnings per se, but because of commentary on the earnings call yesterday. While President Donald Trump's tax bill cuts subsidies for solar installations, Trump's protectionist policies towards Chinese solar panels are really helping for solar. And I say that because the administration's extremely high tariffs on Chinese-owned solar manufacturers is effectively blocking those imports and eliminating First Solar's main competition in the United States. Shares up 15%, Scott.
All right, Christina, thank you. Christina Partsinevelos. We're just getting started. Coming up next, FundStrat's Tom Lee. He is back. As we close out yet another winning month for this market, we'll find out where he sees stocks heading next. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC. Welcome back. Stocks on track for their 6th positive month in a row now. And our next guest doesn't see this rally slowing down in November. FundStrat's Tom Lee. He joins me now. It's good to see you as always. Welcome back.
Great to see you, Scott.
I'm going to take issue like I did last time with a comment that you gave to our producers, Tom. You think it's still the, quote, most hated rally. I just don't know how that still holds water given where we are. I mean, I interview people all day, every day. I've got no bears around.
Well, I mean, maybe some of the bears have gone to hiding, Scott, but because the last time we talked, I wanted to give you some quantitative stats. If you take AAII, which I think is one of the best surveys of high net worth retail investors, it's averaged minus 11.7 this year, negative 11.7. There have only been 3 other times in that survey's 35-year history where the year-to-date average has been negative. It was 1990, 2002, and 2022. So all those times have actually been associated with bear markets. And so sentiment has averaged this year what's consistent with a bear market. So it is the most hated V-shaped rally. Now, there may be some people who say they're no longer bearish, but their P&L doesn't reflect that.
No, that may be fair, which leads us to the potential of a chase into year end when they realize that what's at stake for them if they're not engaged.
That's right. And we know 80% of fund managers are trailing their respective benchmark this year. It's the worst in almost 25 years. So, and now they're given 2 things to work with. One is that seasonally, November's a good month, so it should be a positive month. And as far as earnings go, and you guys had a conversation about it earlier today, margins have been improving despite tariffs. And so it's showing you that companies, I think, using AI are able to expand profit margins. That's actually a pretty good tailwind because the tariff headwinds are fading, but the benefits from AI margin benefits are still going to grow.
Now, I'm a little surprised, maybe not much, but just because you have a history of liking small caps over the last year or so, but particularly coming off the Fed meeting, where the Fed chair went out of his way to say that December is not a foregone conclusion, and then underscored that with far from it, which obviously, if rates aren't going to go down in the trajectory that you probably thought they would, then small caps are probably not going to perform the way you thought they might.
Yeah. One thing to keep in mind is that, if you look at Fed Fund futures, it's still projecting a cut in December. I think Fed Chair Powell in his statements did give you a window for why it's possible. One is he did acknowledge that inflation's effect from tariffs is less than they expected. And despite a lot of Fed governors talking about inflation widening, that's not the case. When you look at the CPI report in September, it was the highest percentage of components, 54%, that were in outright deflation. So in fact, inflation is falling like a rock. And the second was he acknowledged that rates aren't accommodative. They're just less restrictive. And so in a case where there's falling inflation and if jobs market's weakening, I think that that's a good reason for cuts to happen and in a way that's good for equities.
Yeah, but I mean, we were talking about December probabilities, Tom, before the meeting at like 100%. Now they're down. And some, like, Jeffrey Gundlach, who I interviewed the other day post-Powell, was like, could be 50-50. So maybe that particular trade gets paralyzed, if you will, between now and the next meeting because we just need to see what the Fed's going to do before we become big believers in the small caps.
Yeah, well, I'm into something that the Fed will not want to do, which is be a little forward-looking. But we have a government shutdown that's continuing, that is causing even things like air traffic to slow, and inflation isn't going to be gaining strength in a period like that. So if the Fed was acknowledging inflation's weakening now, I think it's even weaker in December, at a time when the labor market is suffering. So I think if someone thinks the odds have dropped because of what the Fed said, I just think the data would support a very opposite picture.
And you still like 7,000 at least between now and the end of the year? I mean, we closed above 6,900 the other day, so we're well on our way, it would appear.
Yeah, that's right. And but it probably makes sense for people to be aware that because October was so strong, we have to consolidate some of those gains in the first half of November. And Mark Newton, our technician, does think that we're going to be entering a period of chop. So 7,000, yes, makes sense, and it's just going to be bumpy in the next couple weeks.
Hey, Tom, have a good weekend. We'll see you soon. That's Tom Lee.
You too, Scott.
Of Fund Strat. Thank you.
Hello, everybody. Welcome to Blue Cloud Trading. I'm George. It is Friday, October 31st. Happy Halloween. We just saw some clips from the halftime report and closing bell. Josh Brown and Tom Lee and some other guests. And we're going to now go over the markets. We're going to take a look at the stocks that they talked about. As you can see, the indices were all up today. Okay. But let me show you guys real quick what we're going to be discussing. We're going to take a look at some of the stocks. Like I said, the S&P 500, the NASDAQ, the Dow, the Russell, the Euro Stocks ETF, FEZ. We're also going to look at about 19 stocks and ETFs that were discussed on the shows. Okay, there's a list right there. I've already reviewed them, so I'm going to do the technicals on these, and we're going to get a better picture about what's really happening. We'll look at some of the Mag 7 stocks like Apple, Tesla, Meta. We will also take a look at some of the strongest sectors, and then we will also take a look at these 4 stocks requested from our members. And remember, you can become a member very easily. All you need to do, folks, is hit the join button. When you're on my page here, Blue Cloud Trading, you will find it right next to the subscribe button. You just click on that join button. Very easy. This is what pops up. Okay, and then you can get access to the membership perks. As a Blue Cloud supporter, you can request a stock to be analyzed or an ETF to be analyzed on an upcoming show. Blue Cloud Trader level, you get 2 stocks or ETFs to be analyzed once per month, and then exclusive member-only videos as well. Now, this is the most important part because every weekend I do an exclusive members-only video where I go over the entire portfolio. I go into an in-depth analysis of the sectors, industries, and find strongest stocks, and I usually give about an average of around 20 stock ideas for the upcoming week. And then in addition to that, well, if you become a Blue Cloud Legend level member, that's the next level up, right? You get all that plus daily trade updates. So for today, like for example, I closed out of a number of positions. I added some positions. You know, Blue Cloud Legend level members are getting that information during the market open, so out before 4 p.m. So it is actionable if you decide that you like the ideas that I'm throwing out there. Also, I also provide the scan results from my proprietary scanner that looks for really strong stocks. All right, now let's get into this, folks. And by the way, yeah, it's the end of the month, so we're going to look at the monthly. We're going to do a little bit of monthly analysis here as well. So here's the Dow Jones. Like I said, it's up 0.09%. It's not a whole lot, right? You can see it was flat early in the morning, dropped in the afternoon, came back up, and then closed just up 0.09%. The NASDAQ actually gapped up in the morning, but you can see here that it actually started to drop, creating a lower high here from the prior high, but it was up 0.61% nonetheless. S&P 500 also gapped up and then also did something very similar. All right, up only 0.26%. And the Russell 2000, this one moved up, okay, and then was up, actually no, I take that back, the second most, up 0.56%. So the Russell 2000 was up a little bit. All right, let's look at the heat map. These are the individual stocks in the S&P 500. You can see Amazon was up 9.58% today. Tesla was up 3.74%. Google down slightly, 0.03, Meta down 2.72, Microsoft down 1.57, Broadcom down 1.82. But Oracle, Palantir were up. There were a number of stocks like in the financials here, like JP Morgan and Wells Fargo, Bank of America, Citigroup, okay? The utility stocks did not do so well. Basic materials didn't do well. Consumer defensives didn't do so well either. And let's look at the 1 week performance real quick. Here's the 1 week performance. You can see Nvidia up 8.71% for the week. Amazon up, Tesla and Google, but Meta down 12.19% this last week. All right, so you can see the percentages there. The brighter the red color, the higher the losses that week. You can see here, if it's this color here, it's -6%, -4, -2. And if it's bright green, it's over 6%. Let's look at the 1 month performance now here too, since we can do that. Okay, and so what you'll find here is Google up 14.36% for the month, Amazon up 9.81, Nvidia up 7.2, Broadcom up 9.3. Look at AMD up 50.9%, Micron up 21.7%. So a lot of the semiconductor stocks did really well. Energy stocks like Exxon and CVX up just slightly, 2.76%. Okay, and then let's just do one more thing. We're going to look at the groups here, and let's look at the sectors and see which ones were strongest today. You can see consumer cyclical was up the most, 2.88%. Utilities down 0.61. Here's the 1 week performance with technology and consumer cyclical at the top, consumer defensive and real estate at the bottom. 1 month performance, technology, utilities, industrials, and then basic materials, real estate, consumer defensive were the 1 month down the most. Okay. All right, so let's get into the S&P 500 stocks here. Folks, what I'm going to be using here is the Ichimoku indicator. And if you're unfamiliar with this indicator, it's a Japanese indicator. There will be a around a 5-minute tutorial on this indicator at the end of this video. So, you can check that out later. So that's why I'm not going to go over it right now. But let's look at the S&P 500. Here it is on the weekly chart. You can see prices above that 673.95 level still from last week. We broke that level. That's very important. It did create sort of a reversal type candle. It's almost like a doji type candle, spinning top / doji. So that's a little concerning on the weekly chart. Here's the daily chart. You can see that we are technically above the moving averages and the Ichimoku cloud. So that's very bullish. But these are not really ultra bullish candles, and you can see that we did actually drop from the highs from Wednesday. So we're down a little bit here. The Qs, here it is on let's start with the weekly chart. It's up above this level here, the 613.18. That's a good thing. But on the daily chart, these last few days have not looked particularly great. Again, Wednesday we had the highs there of 637.01, and right now we're at 629.07. Not particularly strong candles, but we were up nonetheless, 0.48%. You can see that what happened essentially is price gapped up right there and then closed down. So if we switch it to a 5-minute chart, we can see that basically all that transpiring throughout the day here on the 31st. So there's that gap up. It dropped, came back to the opening price, which is that dotted green line that you see right there. Dropped, came close to the yesterday's closing price, which is the dotted the dotted red line there, and then moved up. So it kind of stayed in between the opening and yesterday's closing price, up just 0.48. Here's the Dow Jones. Let's look at this on the weekly chart. Also up, but as you can see, there's a long little wick at the top there. Daily chart, and what that represents is the selling that took place, right? So we reached the high there on Wednesday, and that also, these last few days, prices dropped a little bit. We are still above the Tenkan-sen, Kijun-sen, and the Ichimoku cloud. So overall, we have a strong bullish trend in place. Here's the weekly chart again, and there's the daily. FEZ is the Eurostoxx 50 ETF. Now, this one didn't do so well today. It was down 0.56%. It did not participate in the move up, but it did. So it basically dropped for a second day under the Tenkan-sen, but found support at the Kijun-sen. The Kijun-sen is that 26-period red line that you see right there. What I'm concerned about is the fact that the directional movement index is starting to get a little bit bearish here with the ADX, which represents momentum. You can see that right there is moving up. And when you see that, okay, and you also see the red line moving up and the green line moving down, that's bearish. That's not a good sign. But it is holding up above that the Kijun-sen So that's important. Here's a weekly chart. So all we're seeing here basically is price kind of stagnant for these 5 weeks, essentially. Think about that, 5 weeks in a row where it's just kind of staying in the same range. All right. What about Russell 2000? This one, this one also stalled right there. Here's a weekly chart. You can see how we came close to that 250, 277 level from the week ending October 17th. See that long wick there, the shooting star? We haven't surpassed it yet. Okay. Here's the daily chart. And you can see that what's been happening essentially is price has been stuck in this range. So we're in a range-bound market currently. But technically, if you look at the overall picture here, the Ichimoku, what it stands for is at a glance, and we are technically above the Ichimoku cloud. So that's bullish. Unlike back here in remember when the Russell 2000 in 2024 dropped significantly, it was under the cloud. We are still above it. So that's a good sign. The VIX also jumped a little bit, up 3.13%. It actually got above the cloud temporarily, but then subsided, right? Dropped a little bit. So that's good. The VIX represents volatility. And so, yeah, it's just kind of at a level of 17.44, basically. So, yeah, we'll see what happens with that. Okay, we're going to go into the CNBC stocks, the ones that they talked about. Not all of them, because some of them are in the Blue Cloud portfolio that I'm going to be, and I'll be covering those in this weekend's video. All right, so that's another reason why you may want to consider becoming a member. All right, so let's start with the strongest ones. I've highlighted 4 out of 19. Okay, just 4 of them got the blue flag, which basically what that means is that it looks strong technically on both the weekly chart with price, okay, being above the cloud, above the Tenkan-sen, above the Kijun-sen, the 9 period and the 26 period. The Chikou span is also above price. That's also bullish. And that's what we're looking for, okay? And so there it is in the weekly chart, and here it is in the daily. Now, it did pull back, though, from yesterday. Here's Thursday's high. It did pull back and stalled right at the 9 period. It still got the blue check mark, but it was down 1% today. I'd be watching this very closely. These are reversal candles, and this could pull back more. But it's the fact that it stalled at that 9 period shows strength, actually. Okay. What about Ford? Let's look at that one. Here it is in the weekly chart. Okay, we've got a bearish harami, folks. It's a bearish pattern. It's when price basically gaps down, and then the candle, this candle here is smaller than the larger candle there, and closes within the body of the prior candle. So you can see it dropped a little bit on the weekly chart. So that's not a good sign necessarily, but we are above the cloud, okay? And we're above the moving averages. And if on the daily chart, same thing. So you can see that we've pulled back here, right? Price has pulled back, but it's found support right there at the Tenkan-sen. If it can hold up above there, price getting above that high, I think we'll see it continue to the upside. That's Ford, okay? GM also looking okay here on the weekly chart. There it is, also creating a bearish little harami with a reversal candle this week. It's called a spinning top. Here it is in the daily chart, but it does look, again, strong overall when you look at the entire trend. I'm just zooming out here so you can see the bullish part of the cloud. There it is in the daily, okay? Remember, the cloud itself projects 26 periods into the future. You can check out that tutorial, like I said at the end, to find out more about that. All right, and then we've got the daily chart also looks pretty good, but it's been stalling these last 6 days or so. IBM, let's look at this on the weekly chart. We got a reversal candle here. It was up. You know, it looks like it was up a little bit there above the prior week, slightly maybe. Here's the daily chart. So this is where we're at. We've got a shooting star here from Tuesday, October 28th, and price has stayed under that shooting star. That's not a good sign, but it is technically above the cloud and above the moving averages. Therefore, it gets a blue flag. This might be short-lived. It might pull back slightly more. It might come back down to these moving averages here and then take off again. So that's where we're at, just like it did back here. Okay. The rest of these don't look great. I'm not going to lie. That's why they don't get that blue flag. And check it out. I mean, this is very... Remember, Ichimoku stands for at a glance, And at a glance, you can quickly see that things are not looking good here. Prices dropped under the cloud. Everything looks bearish here. You've got, with the cloud itself, Seiko Span A under the Seiko Span B. Prices under the Tenkan-sen, the 9-period, and the Kijun-sen. It's under the cloud. And the Chikou Span, the white line, is under the price 26 periods ago. That's all bearish. I'd skip it. I would not consider buying this stock because it's unknown exactly when this thing is going to start turning around. At this point, it could continue dropping, and we don't know for sure that this is the bottom. Okay, let's look at BMY. That's also been in a decline here for multiple months. As you can see, we're in a downward channel. These can last a long period of time, these downward channels. And this is months we're talking about now. So, like, yes, we're showing a little bit of strength these last few days. Big jump here yesterday and Thursday, and then it entered the cloud on Friday. But if you look at the weekly chart, it's when you look at the overall picture, you can see that you want confirmation on both time frames, and we don't have that. Here's CLF dropping this last few weeks now under the Tenkan-sen, found resistance at that 200-day moving average right there, the dotted yellow line, and dropped. And here's the daily chart under the moving averages. No on CLF. Coinbase is inside the cloud, so you don't want to be adding positions here either until this thing clears and breaks above. Weekly chart also not looking particularly great with the price under the Tenkan-sen. Fiserv. Look at this one, guys. I'm going to switch it to a monthly chart so you can see what's been happening here. What we had originally was what's called these two candles right here are a tweezer top pattern. It's when the candle wicks are around the same level, like you see right there. That month and that month right there, the price stalled right there. And then once price got under the low of that reversal candle right there, everything started to drop, as you can see. From the highs, we are down approximately 72.05% in this, okay? If you have a position in this, I don't. But Fiserv is not looking good on the monthly chart. It also broke under the 200-day moving average. And look at the volume bar here this month. So this is a monthly chart. This is the weekly. Okay, also not looking great. Daily. Okay, stair-stepping downwards. Nothing you want to see. And then the 200-day moving average is declining. That's not good. So I'd stay out of that one, obviously. Home Depot, same thing with this. I mean, it's under the cloud. So stay out of Home Depot. There's the daily and there's the weekly for you. Marriott is under the moving averages, but stalling right there at the cloud. This has some potential, but I wouldn't be jumping in quite yet. Here's the daily chart. You can see it's under the cloud. McDonald's is also under the cloud. We've got a lower high here from the prior one. This could continue dropping. Pfizer is also, well, it looks like it's under the 200. So it's been stalling at that 200-day moving average on the daily chart. But it did emerge above the cloud here today on Friday. If you look at the cloud, the future cloud, though, the Seiko Span A is still under Seiko Span B. That's bearish. Okay. The Chikou Span is technically above right there. It's above the candles. But, yeah, and Pfizer did, in fact, find some support right there. So there's a possibility that this thing could move up. Would I be taking that chance? No. Okay, here's the weekly chart. We're still inside the cloud on the weekly. So how about QCOM? QCOM actually broke through on the weekly chart above the Ichimoku cloud this week. It was under for a long time. So this is when you start getting interested in a stock, right? You see the breakout. Okay, now we know there's a lot of volume down below. You can see that as well. That means that there's a lot more trading. There's 130.9 million shares traded. I mean, that looks like about 3 times the prior week, right? And their earnings are coming out on November 5th. So this might be some insider stuff going on right there. And the word's gotten out. I don't know. What I can tell you is that long wick that you see right there is not a good sign. That's also, that represents selling. So price reached that level around 206 or so, right? 205.95, and then it dropped back down to 180.90. So it's very volatile. Here's a daily chart. Okay, so it's pulled back these last since Tuesday, but right now it's starting to show a little bit of strength. Once again, it's up 2.05%. You're taking a chance every time that you do decide to add a position right before earnings. And in this situation, it's up to you to make that decision. But there's more a lot more volatility. It can spike up, but it can also spike to the downside if the earnings don't come out as expected. Here's Rocket Companies. This is also stalling right here at this prior low of 15.98. It's at 16.66, and it's under the cloud. So no on Rocket. This was Josh Brown's final trade. Here's the weekly chart. Okay, so we are technically on the weekly. We are above the cloud, but it's been showing a little bit of weakness since September 19th. And here's the daily chart. So I'd hold off on this. You can see currently we have a lower high, and if we get under the 15.98, then we'll also be breaking this low here, and that's not good, because if that happens, then you'll have a lower low. And if that occurs, now you get yourself a nice, beautiful downward channel that can last a little bit. Okay, so hold off on Rocket Companies. SWK also dropping. Okay, reached that 200 right there back on October 28th and then dropped. It's down 1.25. No on this one. Here's TripAdvisor, also under the cloud. It's found some support here at the 200-day moving average, but I'd hold off on this one as well. Here's a weekly chart for you. It's inside the cloud. What about Walmart? Walmart's inside the cloud too. It's been dropping for multiple weeks. You can see here, Chiku span is underpriced. The cloud is still bullish on the daily, but what about weekly chart? Weekly is stalling at the Kijinsen. So Walmart has some potential because of the fact that it's stalling right there on the weekly chart. And if next week we see some strength in the consumer defensive sector, it could turn around. Here's a daily chart, like I said, still dropping. Okay, let's take a look at Wynn Resorts. WYNN is the ticker symbol for this one. And currently on the weekly chart, we just got under the Tenkan-sen, but finding some support at 117.86. Okay, it's also a bearish engulfing pattern. That's also bearish, but it's finding support. So if it gets under 117.86 and closes under there next week, that's going to be a problem for Wynn. It's inside the cloud here. This is certainly not something I would be adding a position in. All right, and that's it for those stocks. So let's take a look at Apple next. Apple had a down day, down 0.38% on the daily chart, but technically speaking, it's still above the moving averages. As you can see, it's above the 260.10 level. It's above the cloud on the daily and on the weekly chart as well. That's why it has a blue flag right there. Tesla on the weekly chart has all of the elements looking okay. The cloud is bullish, but price has been stalling, like I've said multiple times here, under this trend line that I drew. There's the high of it. There's the other high. Okay, there's the trend line. It needs to break through that. It needs to get above 488.54 before it kind of, in my opinion, makes sense to be thinking about Tesla. This is the all-time high right here from going back to December 20th, 2024. But there's gonna be, you're gonna need to have a catalyst for that, right? Here's a daily chart. You can see it's been stalling, and we've got a lower high here than this prior high, so that's why it needs to break through that area. What about Meta? Meta down 2.72%, a continuation to the downside after that big gap down. Remember, on Wednesday, this was October 29th, we were inside the cloud. Okay, so this is another reason why you don't want to be adding positions when price is either under the cloud or inside the cloud, because it shows bearishness still, right? Everything starts falling apart. Here's the first candle where price got under the Tenkan-sen, and it's down 15.27% since that candle right there, September 22nd. So Meta has not looked good, and I've been talking about that for pretty much every video that I cover here. Let's see. Let's continue, folks. All right, we're going to look at the sectors very quickly, just the strongest ones today. I will be going over a more thorough sector analysis in the members-only video tomorrow as well, including gold. So you may want to consider becoming a member. XBI, Biotech ETF. Here it is on the daily chart. Okay, it's above the 110.96. Here it is on the weekly chart. Looking good. I like it. I like it. So biotech looking strong, up 0.71%, and it's got the blue flag. XLI up 0.24%, still stalling at that 155.94. I mean, just look at this. It's been stuck, right, in a box, basically. And so it needs to break through. It needs to get above that level so we can see a continuation. Until that happens, I would not be jumping into this. But I like the fact that it is technically still sound as far as price being above the moving averages, the cloud on both the weekly chart and on the daily. All right, today, for example, there it is. There's the candle from today. Here's XLK. This one technically looks okay, as far as being above the moving averages, but it's been dropping since Wednesday. This is technology. Here's weekly chart. We get a shooting star type candle. That's a little bit concerning. But overall, technology is one of the strongest sectors. Okay, COPX, Copper Miners ETF. I mean, on the weekly chart, still above the moving averages. We still have a bullish cloud. But ever since we got that shooting star candle, which is a reversal candle right there, that long wick and the small red body, you can see how price has been stagnant. It's been staying within it for the most part, right? And so we need to see what's going to happen here. It's just like, this is indecision. Basically, what's happening is neither the buyers nor the sellers are in control here. It's just kind of like stalling, waiting for more information. And then here's the daily chart. So it's pulled back, still holding up above the moving averages. XLY, what's interesting about XLY, yesterday it actually gapped down under both moving averages here, and it closed under the Kijun-sen, but was still inside the cloud. Today, big gap up. They called this an abandoned baby pattern. I'll just show you that because I think it's kind of a funny name, abandoned baby, because basically what you see here is the candle, and there's the parents apparently. This is the Japanese come up with some funny names for the candlestick patterns. Let me just show you this one in the candle pattern reference sheet that we have right here. So this one would be a bullish. This would fall under the triple candle patterns. It's a bullish triple candle pattern, and here it is, the bullish abandoned baby. Okay, so it dropped. There's the first candle. You can see what happens is price gaps down, right? It gapped down right there, and there it is. And then the next day it gaps back up. So that's a bullish pattern. The opposite of that would be the bearish abandoned baby, where it happens at the top, right? So you see the baby at the top of the move, and it drops. We got other names here like three black crows. You got falling three. Okay, the evening star, the evening doji star. These are negative ones on the right side here. If you're unfamiliar with understanding candlesticks, you might want to review this. Opening price, closing price for a green candle. On a red candle, the opening price is at the body at the top, closing price right there. The wicks represents the highs of the day on both the top and the lows of the day, as far as price is concerned. Alrighty, let's get back, folks. So yeah, that's a bullish version of it, and it was up 2.64%. And so yeah, it's the cloud is still bullish here on the daily, and on the weekly chart, holding up, still under that 243.40. I wouldn't be buying it here based on that. I'd wait until it breaks above that 243.40 personally. Here's SMH, the semiconductors ETF. Second, looks like a second week above that 350.05 level. It's down 0.20% today. Here's the daily chart. You can see that doji, and then we have two more days where it's been dropping. But as long as price remains above these moving averages, you can have these negative types candles. Then it's not the end of the move, right? You'll see those throughout this whole uptrend. And so all it tells us is there's weakness. And so, that's all it's giving us information about. All right, now we're going to look at some of the members' requests. Let's look at Lyft. Start with a weekly chart. Here it is on the weekly chart. It still looks bullish on the weekly chart. We have a series of higher highs here. You can see the this candle here is higher than the high there is higher than that one. We have a higher low here than this low. So it's been stepping its way up. I like that. Price is above the Tenkan and Kijun-sen, and the cloud itself in the future is bullish still. So the weekly chart still looks good. Daily chart. Today was up 3.59%. You can see that it entered the cloud yesterday, right? And then it popped right back above. That's showing strength right there. I like that. I like what I'm seeing there. And if you look at the directional movement index also, the positive DI9 crossed the negative DI9 right there. So that's good too. And so personally, I'd be holding this position to see what happens next week because it is holding up above this 1907 level as well. But yeah, it's, overall, I would not be adding, if you're like thinking about Lyft, I would not be adding a new position here. But if you're managing your position, it's still looking like it's, it's holding up. And you can kind of see that on the daily chart here with this little trend line right there. Okay. What about Uber? Uber's kind of doing something similar, right? So yesterday it popped back above the cloud. Today it was only up 0.01% on the daily chart, but held up above the cloud. So that's showing some strength. If you look at the directional movement index, that's starting to look pretty strong, right? The momentum is increasing here. So that's a good sign. And the positive DI is above the negative DI. And then if you look at the weekly chart on Uber, it also popped this week above the Tenkan. So I like Uber. Uber is looking pretty good here. The only thing that's concerning is the fact that you got a couple of things that are not in play yet. So the faster moving average is still under the slower one, right? Green line is under the red line. And then the Chiku span, which is today's closing price, projected 26 periods ago, that's still under the candle. But it looks like we're close. It's looking closer and closer to, Uber popping soon. Maybe next week. We'll see. SMR, New Scale Power Corporation, industrial sector. All right, let's start off with a weekly chart on this one. So on the weekly, we've got a bullish cloud here. Prices in between the two moving averages. We have a bullish harami pattern. So there's a higher probability that next week it will move up. I don't like the profit margins here, the negative 221.07. If you look at the daily chart, okay, Tenkan is under Kijinsen, so that's not good. But it's been showing some strength these last, few weeks. Excuse me. The future cloud is also Senko Span A is under Senko Span B, so that's not good either. But yeah, we're showing some strength. So technically, if I had a position in this, I'd probably be holding it in this point. And if I see further weakness, I'd probably close out. But I wouldn't be adding any new positions here on this one. SMR. Let me take a quick look here at the fundamentals in that one. So let's see here. The last earnings report, you see it's red. Okay, so look at that. The reported revenue was 8.054 million. The estimate was 11.65. They were really off. They were off by 30.87% on their earnings surprise. Now, when is their next earnings? November 6th. It's coming up. Sales quarter over quarter are up 732%. Performance year to date up 150.25%. But you are taking a chance here. You can see there was just the earnings report prior to that. The surprise was 310.75%. So they're not really doing a good job at like predicting how the stock price is going to move and how well it's going to do. So yeah, it looks here like on October 21st, Cantor Fitzgerald changed the rating to overweight. But prior, like other ones like Citigroup, BNP, they went from neutral to sell and neutral to underperform. So interesting. All right, let's take a look at the next stock, folks. QUBT weekly chart. Here it is. Future cloud is bullish, showing some strength here this week. You can see it's up 11.62%, breaking back above the Kijinsen, so that's a good sign. How about the daily chart? It's under the cloud. It just broke above the Tenkan. If you happen to be holding a position here, there's a good chance that next week it will move up. But where will it find resistance? Probably at the cloud, right there. It's a flat cloud right there. It's most likely to find some resistance there. But yeah, I would not be adding new positions here, but it seems to be recovering a little bit. And if we look at this one real quick, let's go back to this. I'm just kind of curious to see this one too. QUBT, Quantum Computing Inc. Their last earnings report, also negative, right? You can see the revenue, a 39% drop there. If we look at some of their other information, like performance year to date, only up 0.97%. You can see that right there. Now, the performance for the year, okay, for the last 12 months, up 1,269.67%. Very volatile stock. I would, advise against buying this stock. It's all over the place. You can see here profit margins here really negative. Okay, 29,053.99. What else can I tell you about this company? There's only 41 employees. You're really taking a big risk in these small companies. That's in the Russell. Market cap is still $3.12 billion. So what do these guys do even? I don't even know what they do. Quantum Computing Inc. engages in developing novel algorithms and solutions utilizing quantum and quantum-inspired computing to solve difficult problems in various industries. It leverages its expertise in finance, computing security, mathematics, and physics to develop commercial applications for the financial, security, and government sectors. Founded in 2001, it is headquartered in Hoboken, New Jersey. What do the, let's see here. I'm just kind of curious to see what the net margins are. Yeah, there were negative net margins. You can see those right there. Yeah, I don't know. I'd stay out of this, folks. What about free cash flow? Do they have any free cash flow? Let's find that out too. Nope. It's been declining. So you can see that year after year. Yeah, this is a risky one. I'd stay out of this one, personally. It's taking a big risk. All right, and that's going to do it, folks, for this video. Stay tuned for the pre-recorded little video on on Ichimoku, which is coming up right now. If you look at the weekly chart for the SPY, I mean, we are obviously in a very strong uptrend here. Just really quickly, let me show you what we're looking at here. This is the Ichimoku indicator. It's a Japanese indicator that was basically incepted in the 1930s, late 1930s, folks. It was published in the late 1960s and then came here to the United States sometime in the 80s, I think, is when they started adopting it. And with software, imagine trying to plot this on a piece of paper. It's based on mathematical models, but imagine trying to do that before computers. So let me just briefly tell you what these lines mean. The green line is the midpoint of the last 9 periods. It's plotted right there. Not the closing price, but the midpoint. So think of each of these candles. It takes the highs and lows of the candle and then divides it by 2, finding the midpoint of each candle. So it's giving us an average, really. And the 9 is the green line is a 9 period. So it's looking at the last 9 periods. This one looks at the last 26 periods, the midpoint, and projects it right under the candle. Okay. The white line that you see right over here on the left, that's the closing price today. All right, so that's today's closing price projected 26 periods ago in a line form. Okay, there's different ways to plot price. So in this case, what we're looking for is for the white line to be above the candle 26 periods ago. And we're looking at a weekly chart, so that's 26 weeks ago. All right, there's the candle 26 weeks ago right there on May 2nd. And so when the white line is above it, it's bullish. If the white line is under, bearish. Here are some instances, for example, where the white line was under for an extended period of time when it probably didn't make sense to be adding positions at that time, okay, in the markets. I'm sure you guys remember 2022, right? It all started right there around 2022, and then it continued through, and then things started to emerge around mid-2023, and then the market started moving up. So what else is this indicator comprised of? It's the cloud itself, right? The Ichimoku cloud. And so that's comprised by taking the Senko span A is the upper line, and that takes the midpoint of these 2 moving averages. And what it does is it projects the midpoint 26 periods into the future. Very unique concept. And then the purple line is called the Senko span B. That takes the midpoint of the last 52 periods, these candles here. Instead of projecting it under the candle like it did in this case, it projects it 26 periods into the future. Cool, right? So we've got things that are plotting in the future. We've got things plotting in the past, all based on price. All right. And it helps to guide us, really. Think of it like that. It's a map, right? It's It's gonna give us some insights about what's transpiring at this particular moment on different time frames. We can look at this on a weekly chart. We can look at it on a daily chart. There's the daily chart right there. That's also bullish. What we want is price to be above the Tenkan-sen, the Kijun-sen, and the Cloud. Okay. And if you're wondering what Ichimoku stands for, Ichimoku stands for at a glance. So the idea is to see quickly, visually, where are we? Okay, on this chart. Very briefly, you know, if all these elements are in play, that we have a very strong uptrend. When things start falling apart and price gets under any of the moving averages or inside the cloud, then there's weakness, and we can identify how strong, you know, the weekend trend is. Thank you for watching. Appreciate all of you guys. Don't forget to hit the like, subscribe button, and click the join button, and maybe consider sharing this video with someone. And I'll catch you all in the next video.